I was shocked when I heard what my mortgage payment was going to go to when it was our turn to renew in a couple of years. Well, what does this look like for the average Canadian? What options do you have as you move into the coming years? As most mortgages are renewing, whether you're seeking affordability or more space? Well, let's jump into some numbers and some data so that you can actually see what this looks like on paper. I read the other day on ratehub.ca, it said that $251 million in mortgages will be up for renewal by the end of this year alone, followed by another $352 billion in 2025. And in fact, 80% of all the mortgage loans that were in force as of February 2022 will go through renewal in 2024, with virtually all outstanding loans renewing by 2026. So what does this look like? Well, this affects you regardless if you're looking for more affordability, staying where you are, or upsizing your home. The only people who aren't affected are those with no mortgages. So how does this payment jump impact you in your home? Well, let's look at a scenario from 2021 to potentially 2026 with a 5-year locked-in rate. So someone may have, let's say in 2021, we've been living a year of, the wonderful year that we all had in 2020, and you're like everybody else who wanted to make a change and move. So many people made transactions and moved in 2021. You found a detached home here in Calgary for $500,000. You put 10% down on that property, and your principal plus CMHC was a $463. So that was your mortgage amount. Now you got an interest rate of 1.8%. Mind blowing. Now, some of the interest rates were a lot lower. Some of them were like 1.39 was the lowest that we saw. So 1.8, I know people that did that. You put a 25-year amortization. Your insurance at the time was roughly $2,000 a year. So all in all, every month, your payment was $2,395. And that is what it cost you to have this property. And at that time, your household income, let's say, was about $110,000. So after taxes, your net monthly take home, that was your mortgage cost, I should say, down here, was 38% of your net take home. So it's a little bit high, but it's doable. It's very, very doable. It's within that under 35-40% kind of range. Now, what if you fast forward to 2026? Now, we got to have a few caveats here. We don't know what prices are going to do. We don't fully know what mortgage rates are going to do, but we can kind of speculate and kind of play with some numbers. So moving forward, that $500,000 house today is potentially around $700,000. We've seen increases that much over the last 3-4 years. So at time of 2026, there is a chance that we could see an $800 price range, even if we did $750, $775. So let's start with $750. And let's say, that's what your price is going to look like. With your mortgage, you probably have about 40% equity, so about $300,000, because many people, when they see their values go up, they pull equity and do something with it, whether it's paying down mortgage or car debts or other debts, whether that's developing a basement, lots of things. So I just kind of said, you know what, you probably pulled some money, and at the end of 5 years, you would have had a mortgage of about $390, but then you add in that rough 50 number. So this one is saying 450. I'm not going to split hairs here, but right now you see roughly about 450. Now, 4.79 is kind of where 5-year fixed numbers are right now. So we could end up seeing something where it's 4.4 in the future years as well, or even potentially a little bit less. But remember, the fixed rates are not tied to the interest rates that the Bank of Canada sets. They are tied to the bond market. So the bond market, when that moves down over the coming years, or adjusts up or down really over the coming years, that is where fixed rates are tied to. So if you want to keep your amortization the same, let's keep it at 20 years right here. And insurances have gone up. Insurance has gone up for houses. So $3,800 roughly, we could even probably say a little bit less, but just using some rough numbers. So at the end of the month, when you renew, actually, I also said you made more money. So you're getting $15,000 more per year coming in, which is bringing more monthly net numbers to you. But that same mortgage, your same house, when it comes to renew, because of the increased price, because of the increased interest rates, you are now looking at $3,542 for that mortgage, where you were paying just under $2,400. That's a pretty big jump, $1,100 per month extra for your property just because you had to renew. So I don't think this scenario is that unique. It's very, very likely that you could see something like this happen to your mortgage and your home if everything is kind of similar. So what do? What are some options? Well, the first option that you have that you can look into is actually looking at your amortization. This is something everyone can do. So when it comes time to renewing your property, if you are on a fixed rate, your amortization would have come down. If you're on a variable, your amortization probably is really messed up like mine, and you're gonna have to change your payments to get that. Anyways, it's a long story. So on a fixed interest, I should say, you're gonna have 20 years left because you already paid 5 years. So if you change that to 25 years, well, now it brought it down to roughly $3,200. So now you are, what was the one before? 24. So it's not as big of a jump, but there's still definitely a big jump there. So now you're about $700-800 more a month versus $1,100 more a month. So that's one thing you can do. So now you might be a part of the second category of people that we're talking about, where you want to upgrade your property. You may have, over the last number of years, been able to have some savings, put cash aside. You have more equity in your property than you've seen in the past, and you are actually looking at it going, my family's growing, I need more space. We've been living in XYZ house or condo or townhome for so long, and now we want to make the jump into a bigger space. Whatever that is, whatever that looks like for you, there are a lot of you out there that are trying to figure that out. And I think you're in a great situation, because as we move into the coming years, some of the market that is a little bit slower than the other parts of the market is the higher end. So if you are looking at spending probably $700, $800, $900 or more on a property, you are probably going to be sitting in a decent situation, because the property that you own is going to have more demand than the property that you want to buy. So this is a good thing. However, do you sell first? Do you buy first? You need to structure that transition properly prior to the renewal of your mortgage, and kind of timing everything well. So if that's you and you're in that situation, we actually shot another video where it's about 7 mistakes that luxury buyers make, and there'll be a huge benefit to you to watch. So I'll throw it up over here on a card, but don't jump there yet, because you'll probably want to reach out to us. You probably want to have a conversation. We probably want to set a strategy up for you when that time comes. Now, the third category we're going to talk about is those of you that are finding affordability. If you are in the place where maybe your income isn't the same, it's dropped, perhaps a spouse has passed, so there's less income coming in, or the home is too big, kids have moved out, you're kind of in a different phase where you're wanting to find or keep something affordable, you don't want to pay more. Well, there's a few options that you can consider. The first one is building a suite or having more income from your property. With the recent changes in the zoning in Calgary that are going to be taking effect, this is going to be a little bit easier for you to do. There's options of doing basement suites, garage suites. There's different options for your current property that can bring in some income that make it a little bit easier. One person that I know recently was able to move up to a larger home. They ended up spending almost $200,000 or more from what they sold, and they actually had a basement suite in that property. Now, their monthly cost only is going up $100 to almost double their square footage, which is a huge thing. So there are options to do that as well. But having multiple streams or another stream of income coming in from your property could really help you set aside cash and keep things affordable so you can stay living where you're at. Now, the other option is downsizing. You could look at downsizing to a lower priced property. So let's say you're living in one of these detached homes that are now $700,000 and you want to make it smaller. You don't need 2,100 square feet anymore. And you're actually okay with 1,400 or 1,200 square feet because it's maybe just the two of you or one of you or three of you, whatever it is. But affordability and the cost of it is much more important than the size of home that you have. So that is just an option. But you also have to have a strategy. You need to know what to do, how to kind of, I was gonna say wiggle, but you need to know how to kind of maneuver through that process to be able to structure it properly, because we don't want you to be homeless. That is the biggest mistake. It depends on your situation, but most cases you need to find the place before you sell the one because there's just a lack of inventory. And so properties are selling quicker, but not everything. Not everything's selling quicker. Most things are selling quicker compared to years past. Now, we could be walking into a place, into future years, where those, put it on the market and within 24 hours, you got 6 offers, might not be there. Now, I hope that more inventory comes on our market as we move into 25 and 2026, but it's really hard to know how that's going to play out. So if you're downsizing, having a strategy to being able to figure out how to maneuver through that process, buying first, selling first, the mortgages, all of that, we can help you with that. Let us create a strategy so that you are put in a power position and it works for you and you're going to be happy at the end of the day. So the third option that we have for those of you that are looking for affordability is moving, just literally moving out of Calgary. Now, there are some great options for smaller towns that are more affordable that are around Calgary. They're easily within a driving distance, within, let's say, 45 minutes of city center, and you can commute if you absolutely had to. This might be a great example of options for you when you're doing that. And if that is you, then you need to watch this video right here because we got 5 incredible towns where you should consider moving to.